The live price for CoreWeave Inc. CRWV is currently sitting at $95.06, marking a sharp drop of $9.95 or 9.47% in today's session. The market is clearly reacting to the company's latest earnings report, and this immediate double-digit percentage decline is the headline reality that's clashing hard against the pre-earnings expectation. The deeper insight here, the angle you might not immediately anticipate, is that this isn't a drop because of bad demand, it's a drop because of delayed fulfillment. The market expected the AI infrastructure story to be one of flawless, linear execution, and CoreWeave's guidance cut, even a small one, due to a supply chain snag, a single third-party data center developer falling behind schedule, shattered that perfection narrative. This subtle shift from unstoppable growth to growth with friction is what's causing the outsized volatility today, showing just how little tolerance the market has for execution risk in the highly valued AI space. The prevailing market belief about CoreWeave stock is straightforward. It is a pure-play alternative AI cloud provider, the specialized anti-hyperscaler, powered by massive contracts with titans like OpenAI and Meta, and essentially acting as a proxy for the unprecedented demand for NVIDIA's high-end GPUs like the H100 and soon the Blackwell chips. The Q3 report confirmed the core bull case. Revenue soared 134% year over year, and the total revenue backlog nearly doubled to $55.6 billion. That number, $55.6 billion, is the expectation distilled, a staggering validation of its strategic focus on GPU-accelerated compute. The reality, however, introduced complexity. While revenue beat estimates and the net loss narrowed significantly, the company's full-year 2025 revenue forecast was trimmed slightly to a range of $5.05 billion to $5.15 billion, down from the previous high end of $5.35 billion. That roughly $200 million guidance cut, directly attributed to a third-party construction delay, is the pin that pricked the bubble of perfect expectation. Investors who had priced in smooth sailing are now grappling with the fact that even the hottest AI story is constrained by the brick-and-mortar realities of data center construction, power availability, and supply chain logistics. This is the tension. Demand is unprecedented, but delivery is a messy, real-world operation. The current sell-off is less about the quality of the business and more about recalibrating the implied execution premium baked into the valuation. Analyzing the recent stock movement, this price action is highly sensitive to institutional trading and headline news. Following the earnings release, the stock experienced massive downward pressure. This is a classic reaction, where a massive positive-looking backlog, the $55.6 billion figure, is overshadowed by an immediate negative operational detail. Institutional activity is likely driving the volume. When a stock carries a high growth premium, the first sign of a hiccup causes fast money to exit, leading to sharp declines, especially on a day where there are broad market jitters about tech valuations. The downgrades from major institutions like J.P. Morgan, which moved the stock from overweight to neutral, further compounded the selling. The J.P. Morgan analyst, while maintaining a fundamentally tremendous long-term opportunity view, cautioned investors to brace for a wild, lumpy, volatile ride. This professional opinion captures the new reality perfectly. CoreWeave is a long-term winner, but a short-term trading vehicle subject to enormous swings on minor execution issues. The trading volume today is substantially higher than average, signaling a high level of conviction in both the selling and the eventual dip buying, but for now, the sellers are clearly in control. We are seeing what happens when the narrative shifts from the AI infrastructure leader to the AI infrastructure leader dealing with construction delays. The move is disproportionate, which often indicates a washout of weaker hands or algorithmic de-risking based on the guidance revision. This high volatility creates opportunities for sophisticated individual brokerage accounts and traders utilizing platforms like Interactive Brokers Trading, which can handle rapid, large-volume execution. But it also underscores the risk for less experienced traders on platforms like Robinhood Stock Trading. CoreWeave's core business model is not that of a typical cloud provider like AWS or Azure. It is a specialized GPU Cloud Infrastructure as a Service (IaaS) provider. The company's unique selling proposition is a high-performance, purpose-built cloud architecture optimized for compute-intensive workloads like training and serving large AI models, rendering, and scientific computing. They achieve this by focusing almost exclusively on NVIDIA's high-end GPUs, offering better utilization and more flexible deployment options than general-purpose hyperscalers. They essentially act as the AI factory floor, leasing out the most powerful compute resources on a pay-as-you-go or reserved instance basis. Their major revenue streams are derived from these multi-year, multi-billion-dollar enterprise-level contracts with major AI labs and hyperscalers, providing significant revenue visibility, hence the massive backlog. Their success is a direct function of the demand for AI, which is why the stock has been a high flyer, even after the IPO. This model requires enormous upfront capital expenditure, as CoreWeave needs to buy the chips and build the data center capacity to fulfill its contracts. They have financed this expansion through significant debt facilities, including a multi-billion-dollar secured debt financing facility, which introduces interest rate and financing risk that must be carefully managed. This is where the tension between expectation and reality gets interesting. The expectation is infinite AI demand. The reality is the finite and costly nature of capital required to meet that demand. The management team's ability to transition from a private growth-at-all-costs structure to a publicly traded entity focused on capital efficiency is under intense scrutiny. Moving beyond the recent quarter, CoreWeave's strategy has involved vertical integration through acquisitions. The purchases of companies like Weights & Biases and OpenPipe signal a calculated shift to move up the value chain. Weights & Biases provides integrated tools for model training and experiment tracking, essentially building a developer-facing ML ops layer on top of their compute infrastructure. This is a critical move. The goal is to evolve beyond just being a seller of GPU hours to a fully integrated AI-native cloud platform. If successful, this software layer could enhance stickiness, differentiate them from competitors, and potentially lead to higher margin revenue streams. However, this is still the expectation. The reality is that the revenue contribution from these software acquisitions is currently modest compared to the multi-billion-dollar infrastructure contracts, meaning the stock is still overwhelmingly priced on the infrastructure business. The long-term success of this strategy will depend on the seamless integration of these tools into a cohesive developer ecosystem, a challenge that even the largest tech companies, the Apple stock and Tesla stock of the world, grapple with in their respective ecosystems. The macroeconomic context adds another layer of pressure. The AI infrastructure space is intensely capital-intensive and susceptible to global supply chain pressures, a fact demonstrated by the current stock reaction. CoreWeave's reliance on NVIDIA stock for GPUs is a double-edged sword. It gives them best-in-class hardware, but it ties their execution directly to NVIDIA's production and allocation cycles. Any loosening of GPU supply, while generally positive for the industry, could potentially increase competition and put pressure on CoreWeave's pricing power if the competitive moat, their optimized infrastructure, isn't strong enough. Furthermore, rising power costs and interest rates make the financing of massive data center construction more expensive. The Federal Reserve's posture on rates, a constant topic of discussion on platforms from Schwab Intelligent Portfolios to Fidelity Brokerage, directly impacts the cost of capital for a company like CoreWeave, which uses significant debt to fuel its growth. Looking ahead, the future outlook for CoreWeave depends entirely on its ability to quickly and cleanly resolve the operational delays and demonstrate improved capital execution. The primary catalyst remains the conversion of that enormous $55.6 billion backlog into revenue. Any news regarding the resolution of the single delayed data center or the successful on-schedule activation of new capacity will be a major positive catalyst. The company's continued expansion, including its commitment to AI infrastructure in Pennsylvania and its expansion into the UK, shows the conviction in long-term demand. The sovereign demand for AI compute, with agencies like NASA joining their client list, represents a new, potentially highly stable revenue stream. Another key catalyst to watch is the adoption rate and revenue generation from the acquired software tools. If CoreWeave can show meaningful operating leverage, that revenue is growing faster than operating expenses, it will validate the long-term profitability story. Investors will be scrutinizing the adjusted operating income margin, which slipped from 21% to 16%, and whether management can reverse that trend. The current challenge is to prove that the recent guidance cut is an isolated speed bump and not a sign of fundamental systemic issues